Imagine you're looking at an X-ray of a broken arm. It's incredibly satisfying in this sort of clinical way, you
Oh,
know?
yeah, like the jagged white line of the fracture is just right there on the film.
Exactly. The doctor points to it, you look at it, and there's zero ambiguity.
Right.
The bone is broken, the diagnosis is totally clear.
It provides a sense of certainty, I think. Human beings crave that kind of binary categorization. We want to know definitively if something is healthy or if it's, fractured.
Right. But when you step into the world of public market investing, and specifically when you and I are going on this hunt for a company's vulnerabilities today, that pristine X-ray machine just gets thrown right out the window.
Oh, completely. The diagnostic landscape we're walking you through today it's murky. It's highly subjective.
And the patient we're examining is actively trying to convince us that they are in, like, peak physical condition.
Well, that's just the nature of the public markets, right? I mean, a publicly traded corporation is essentially a living, breathing organism. Management teams have entire departments dedicated to investor relations.
Oh, yeah, the spin machine.
Exactly. Their primary job is to present the healthiest possible narrative to the world, smoothing over the cracks and essentially hiding the fractures.
Which brings us to the mission for today's deep dive. We are bringing you along on a really highly specific, very aggressive analytical exercise.
A stress test.
Yeah, exactly, a stress test. We're adopting the persona of a public market investor, and our goal is to construct and test a short investment thesis for a company called Planet Labs. Ticker is PL.
And to do this properly, I mean, we really need to establish the parameters of this hunt for you, the listener. We're searching the market for the absolute highest conviction short candidates.
Right.
But here is the critical constraint we're placing on ourselves today, and it's a big one. We are strictly, entirely ignoring valuation.
Let me just underline that for you, because it is so vital to how we operate here. We do not care if Planet Labs stock is trading at 20 times revenue or like 2 times revenue.
Right, the multiple doesn't matter today.
We are not arguing whether the market cap is too expensive or too cheap based on some arbitrary number.
We are focusing purely on fundamental structural vulnerabilities. We want to find the rot in the foundation of the business itself.
Yes. So that means we're hunting for deteriorating unit economics.
We're looking for an eroding competitive moat.
We want to identify structural industry headwinds that are, about to blow the house down. And crucially...
And the management team red flags.
Exactly. That includes examining their capital allocation track record, questioning their corporate governance, tracking insider turnover, and combing through their accounting practices for any aggressive revenue recognition.
And to do this, we've assembled a massive stack of source materials. I mean, we're looking at their 2024 10K, the 2021 S4 filing from back when they went public.
The 2025 proxy statement?
Yeah, that too. Plus Investor Day slide decks and transcripts from their earnings calls all the way through the fourth quarter of fiscal year 2026.
We are reading the fine print so you don't have to. But before we open the first document, we have to invoke what we call the intellectual honesty clause.
This is the most important ground rule for the entire exercise, honestly. As short sellers, we're going to bring an intense level of skepticism to every single comment management makes.
Because they're always going to spin it.
Right, we expect them to spin the story. However, we will not, under any circumstances, manufacture a bearish conclusion if the evidence in these documents just doesn't support it.
Yeah, if Planet Labs has a fortress of a competitive moat, or if their unit economics are genuinely scaling and healthy, we're going to admit it.
A defensible no-thesis conclusion is infinitely more valuable to an investor than a fabricated, highly biased short thesis that ultimately just blows up in your portfolio.
Nobody wants that. We have to follow the data. If the bear case fails, we explain exactly why it fails. Okay, so let's unpack this company. Planet Labs operates a fleet of around 200 Earth observation satellites. Their headline claim is that they scan the entire landmass of the Earth every single day.
Which is wild to think about.
It is. On the surface, that sounds like incredible, futuristic sci-fi technology. But we need to figure out if the underlying business model attached to those satellites is actually a house of cards.
Right.
So let's start with their primary competitive advantage, their moat. Is their unique peripheral vision of the Earth starting to go blind?
Well, to evaluate their moat, we really have to look at the historical context of the satellite imagery industry. For decades, this industry was built almost entirely around what we can describe as staring vision.
Okay, staring vision. I want to make sure I'm visualizing this correctly. By staring vision, you mean taking a massive, incredibly expensive satellite, pointing it at a very specific spot on the globe, and taking an extremely high-resolution photograph.
Like a sniper scope.
Right, like a sniper scope.
That is a perfect analogy. The industry prioritized spatial resolution above all else. If an intelligence agency wanted to read a license plate or identify the specific model of a fighter jet on a runway from space.
They tasked a multi-billion-dollar satellite to just stare at that specific target.
Exactly. The primary customers were defense and government agencies, and they paid a massive premium for that deep, penetrating stare. But Planet Labs came along and just flipped that paradigm upside down.
They decided to prioritize temporal resolution over spatial resolution.
Yes.
Okay, temporal resolution, meaning the frequency of the images, not just how crisp they are.
Right. Instead of taking one flawless, high-resolution picture of a specific target once a week, Planet's strategy was to take a moderately good picture of everything, everywhere, every single day.
And the sources mention a fantastic story about this. Robert Cardillo, who used to be the director of the National Geospatial Intelligence Agency, the NGA.
The NGA.
He gave a talk at an S&P Global Market Intelligence Conference. He's actually the chairman of Planet Federal now, but back when he was running the NGA, Planet's founders came to him with this exact pitch.
And Cargilla admitted in that transcript that his initial reaction was just total disbelief. I mean, his head practically exploded.
Because it went against everything they knew.
Exactly. The legacy mindset in intelligence was so geared toward that high-resolution sniper scope that the idea of blanketing the Earth with hundreds of smaller, cheaper satellites to take daily, lower-resolution images seemed impossible. And frankly, kind of useless to the old guard.
But Cardillo eventually understood the value, and he used this brilliant analogy that really clarifies what Planet Labs actually sells. He called it peripheral vision.
Oh, the water bottle analogy.
Yes. If you are walking down the street and staring straight ahead, that's the legacy satellite. But if someone throws a water bottle at your head from the side, your peripheral vision might not be sharp enough to read the label on the bottle, but it detects the movement.
It flags the anomaly.
Right, it flags it, and your brain tells you to duck.
And that daily scan provides the anomaly detection. Because Planet has stacked up thousands of images over virtually every piece of land on Earth, day after day, year after year, they have created a temporal data set that simply did not exist before.
You can essentially rewind time.
Yeah. You can see the exact day a new logging road appears in a protected forest, or you can watch the progression of troop buildups at a border over a 30-day period.
So that is the core competitive advantage. That is the moat. But here is where we put on our short seller hats, because the evidence in their own SEC filings suggests this moat is facing severe structural threats.
Major threats.
If we look at the risk factors in their 2024 10K, they drop a massive, glaring admission about the state of their fleet.
The 10K risk factors are always revealing, but the specific line is striking. They state quite plainly that competitors might build a competing fleet of satellites that is larger than Planet's current fleet.
And then they add this crucial phrase, right?
Yes. Quote, a potential that is heightened by the fact that we may keep our fleet at its current size for the near term. Unquote.
Wait, let me make sure I am grasping the magnitude of that statement. Their entire identity, the sole reason a customer buys their data instead of a competitor's, is this unique daily scan of the whole Earth.
Right.
But they're voluntarily admitting they might just cap their fleet size, keeping it stagnant, while acknowledging that rivals are actively trying to outscale them.
It is a remarkable admission of vulnerability in a public filing. I mean, you have to remember the environment they're operating in. The commercial space race is not some mature, slow-moving utility sector.
No, it's a land grab.
Exactly. It's a hyper-growth, incredibly capital-intensive land grab. Technological obsolescence happens rapidly.
It feels like a software company deciding they're just going to stop releasing updates. Imagine Microsoft saying, you know what, Windows 11 is good enough, we're going to keep our engineering team at its current size, while Apple is actively doubling their R&D budget for the next operating system.
Yeah, that's a great way to frame it.
How does that not immediately begin to erode Planet's moat?
Well, the short thesis argues that it does erode the moat, and it erodes it quickly. The moment Planet taps the brakes on expanding their legacy Planet Scope fleet, which is the constellation that actually performs that daily scan, they leave the door wide open for well-funded competitors.
Just wide open.
If you are a rival aerospace company with deep pockets and you see Planet pausing at roughly 200 satellites to save cash, Your strategy becomes really
You
obvious.
build 300 satellites.
Exactly. You build 300 satellites, and you equip them with sensors that represent the next generation of technology.
And the 10K explicitly warns about this. It notes that competitors often have long-established relationships as preferred providers with massive government clients.
Yes, the big defense contractors.
Right, and these rivals are pouring money into research and development. This isn't just paranoia. In the 2021 S4 filing, they warned that if they fail to develop new designs and technologies in a timely manner, the business could be materially harmed.
Because if a rival successfully achieves a daily span capability, but their hardware provides superior spatial resolution or more advanced spectral bands, Planet's primary differentiator vanishes overnight.
It's just gone.
The unique proprietary dataset becomes commoditized.
And when a proprietary data set becomes a commodity, your pricing power collapses.
Huh.
I mean, you can't charge a premium if your customer can get the exact same peripheral vision from 3 other vendors.
That is the first foundational pillar of our short thesis. We have an acknowledged risk of strategic fleet stagnation occurring at the exact moment better-funded competitors are scaling up.
So, if the moat is actively bleeding out because competitors are catching up, the next logical question for an investor is, how is the management team responding?
Right. Are they fighting back?
Exactly. Are they positioning the company to aggressively defend their market share, or are they busy building walls to protect themselves from angry shareholders? Which leads us straight into our second major area of focus: the management team red flags, the corporate governance, and their history of accounting aggression.
When you are building a fundamental short thesis, analyzing corporate governance is crucial. Governance dictates how easily a failing strategy can be corrected.
And in the case of Planet Labs, the corporate structure is engineered to be virtually impenetrable from the outside.
Completely impenetrable. Let us examine the mechanics of that dual-class structure. In a traditional public company, one share of stock equals one vote.
Right.
But in a dual-class system, the founders or corporate insiders hold a special class of stock. In Planet's case, Class B shares that carry vastly disproportionate voting power compared to the Class A shares that you and I can buy on the open market.
It is the ultimate Silicon Valley maneuver. They are essentially saying, we want the public market's capital, but we absolutely do not want the public market's opinions on how we run the business.
The 2025 proxy statement doesn't even try to hide the intent behind this structure.
No, it spells it right out.
It explicitly states that the dual-class setup strengthens our founders' ability to focus on our public benefit purpose without the risk of challenges by hostile takeovers or other actions that could be focused on short-term gains.
So the co-founders, William Marshall, the CEO, and Robert Schingler Jr., the chief strategy officer, the guys who started this whole thing back in a garage after leaving NASA Ames, they hold total control.
They hold absolute authority. For a short seller, an impenetrable dual-class structure is a massive flashing red indicator.
Oh, absolutely.
Because in a normal public company, the ultimate mechanism for accountability is the shareholder base. If a management team makes a catastrophic strategic error like, say, allowing their core competitive moat to erode by stagnating their fleet, the stock price plummets.
Right, and when the stock plummets, activist investors step in.
Exactly. They buy up a significant percentage of the shares, they force a change in the executive suite, they demand a sale of the company to a larger rival, or they mandate an entirely new capital allocation strategy.
But because of Planet's dual-class structure, an activist investor could theoretically buy 90% of the publicly traded Class A shares and still be entirely powerless to force William Marshall out of the CEO chair.
Powerless.
They couldn't force a sale. They couldn't change the board.
The management team is insulated from the consequences of poor execution. The public markets have no lever to pull to force a course correction.
You're just stuck.
If the business starts to fail, you are entirely reliant on the very founders who caused the failure to recognize their own mistakes and voluntarily step aside.
And historically, human nature and executive ego make that an incredibly rare occurrence.
To put it mildly.
And while we are looking at the executive suite, the sources also show some significant power shifts and turnover that we need to examine.
Executive realignments often signal deeper operational shifts. If we look at the Q4 2024 earnings call, there was a major announcement regarding Kevin Weil. He had been serving in a central operational capacity, but he stepped down to become an advisor to Planet Labs PBC while remaining on the board of their Planet Federal subsidiary.
Yeah, they filed a formal advisory agreement with him in May of 2024. They're paying him to stick around, but in a significantly diminished, non-operational capacity. And right as he steps back, Ashley Johnson steps up.
She did.
She was already carrying the titles of Chief Financial Officer and Chief Operating Officer, and she added the title of President to her resume.
Consolidating the roles of president, COO, and CFO into a single individual is a highly unusual concentration of executive power.
It's all the major levers in one pair of hands.
While management will argue this streamlines decision-making, from a risk management perspective, it creates a massive single point of failure. You have one individual overseeing the daily operational execution, the financial reporting, and the strategic presidency of the company, all during a period where they are managing incredibly complex, capital-intensive engineering programs.
So, we have entrenched founders, shielded by a public benefit corporation dual-class structure, and a highly concentrated power dynamic in the C-suite.
It's a lot of risk.
If I'm an investor with no power to stop them, I need to look very closely at how this specific team spends money. So let's look at their capital allocation track record, specifically their history of acquisitions, because the documents reveal a pattern that is, honestly, highly concerning.
Planet has historically relied heavily on acquisitions to grow. I mean, they bought Blackbridge in 2015, they bought Terabella from Google in 2017, and they acquired Vandersat.
Right.
But if we want to understand the risks in their capital allocation, we really need to do a deep dive into their acquisition of a company called Boundless Spatial in March of 2019. It is a textbook case study in how capital can be destroyed.
Okay, let's pull up the notes to the consolidated financial statements from 2021. According to the filings, Planet acquired Boundless for a total purchase consideration of $17.2 million. And it wasn't all cash, right?
No, the majority of that purchase price was paid using Planet's own Series D convertible preferred stock.
To understand why this is a red flag, we need to explain the mechanics of acquisition accounting for the listener.
Sure.
When a company like Planet buys another business, they are purchasing all of its tangible assets, the office equipment, the servers, the cash in the bank, as well as identifiable intangible assets like existing customer contracts or proprietary software.
Right. However, the purchase price almost always exceeds the fair market value of those specific assets.
The buyer pays a premium.
Yes. And in accounting terms, that premium, the difference between the purchase price and the value of the tangible and identifiable intangible assets, is recorded on the buyer's balance sheet as something called goodwill.
And when we look at the Boundless acquisition, the goodwill number is staggering. Out of that $17.2 million purchase price, an incredible $13.2 million was recorded purely as goodwill.
Roughly 75% of the entire purchase price was essentially air. It was a massive premium paid based on the expectation of future synergies. The financial statements actually spell this out, noting that the goodwill represents the value they expected to gain from the operational enhancements and competitive advantages of integrating Boundless into Planet's existing architecture.
But here's why a short seller cares about goodwill. Goodwill doesn't just sit on the balance sheet forever as a trophy. It is a vulnerability.
A huge vulnerability. Under standard accounting practices, goodwill cannot be amortized, meaning you don't gradually expense it over time. Instead, it sits on the balance sheet and must be tested for impairment at least once a year.
And if it fails that test?
If those magical synergies that management promised never actually materialize, or if the integration is a disaster, or if the acquired business stops generating the projected cash flows, the company is forced to write down the value of that goodwill.
That write-down is called an impairment charge, and it hits the income statement as a massive, sudden loss. It is the accounting equivalent of admitting, we overpaid for this, and that capital is now dead. Now, the intellectual honesty clause requires us to note that the 2021 financial statements explicitly state that no goodwill impairment was recorded for the years ended January 31st, 2020 and 2021. They did not immediately write off the Boundless deal.
That is true. However, for an investor hunting for fundamental weakness, a balance sheet loaded with historical goodwill from a string of roll-up acquisitions is a massive underlying risk.
It's like walking on a tightrope.
Yes. If the core business growth slows down, those goodwill valuations become incredibly fragile. It shows a management team willing to dilute their own equity by issuing preferred stock to pay massive premiums for unproven synergies.
And the accounting aggression doesn't stop at acquisitions. We have to look at how they recognize their actual revenue. This is where we get into the real machinery of the business model.
Right. In the 2023 Investor Day presentation, management included a very detailed slide breaking down their recurring revenue model. They proudly highlight that 92% of their revenue is generated from ratable data subscriptions.
Let's define ratable for the listener.
Mm.
If a government agency signs a 12-month contract for $120,000 to access Planet's daily scan, Planet does not claim that entire $120,000 as revenue on day one.
No, they don't.
They recognize it ratably, meaning evenly, over the life of the contract. So they recognize $10,000 of revenue every single month for a year. That is the gold standard for a SaaS, or software as a service, business model.
Okay.
It creates smooth, predictable financial statements.
It does. But then the presentation addresses the remaining 8% of their revenue. The slide labels this segment as the majority archive, referring to customers purchasing access to the historical backlog of images Planet has collected over the years.
Okay.
And for this specific segment, the slide explicitly states that it features upfront revenue recognition.
Upfront revenue recognition.
Mhm.
Those are dangerous words in public accounting.
Very dangerous. The mechanics of upfront revenue recognition create a significant vulnerability, particularly when paired with the dual class structure we discussed earlier.
Also,
By recognizing the revenue for access to historical archive data immediately upon the signing of the contract, rather than ratably over the duration of the customer's subscription, management gains a powerful tool to manipulate short-term financial results.
let's walk through how that manipulation could theoretically work. If Planet is approaching the end of a fiscal quarter and they realize they're going to miss Wall Street's revenue expectations because their core ratable subscription sales are softening, they have a lever they can pull.
Exactly.
They can aggressively incentivize a customer to sign a massive multi-year contract specifically for archive data access. Because it is archive data, they recognize all of that revenue upfront in the current quarter.
They pull forward future demand to plug a hole in the current quarter's income statement. It allows management to paint a rosy top-line financial picture today, artificially inflating the growth numbers and masking underlying weaknesses in new recurring bookings.
It is the corporate equivalent of taking out a payday loan to make it look like you got a raise. You look richer today, but you are starving your future quarters of that revenue.
It's a great analogy. When you synthesize these elements, an impenetrable governance structure that shields the founders from accountability, a history of issuing stock to pay massive goodwill premiums for acquisitions, and the targeted use of aggressive upfront revenue recognition to potentially mask core subscription weakness, you have the foundational building blocks of a devastating fundamental short thesis.
Let's summarize where we are. Our X-ray is showing some serious fractures. The legacy moat is eroding because they are stalling fleet expansion while competitors aggressively scale. Management is untouchable, they overpay for synergies, and they use accounting levers that could pull forward revenue.
It's not looking good.
But the bear case gets substantially worse when we look at where they're actually spending their cash moving forward.
Yeah.
That brings us to Section 3, the CapEx trap and the growth initiatives.
Right, because if the moat protecting the legacy business is vulnerable, management has to find new avenues for growth. And Planet is not sitting still. They are executing on two massive, incredibly ambitious growth initiatives simultaneously.
And this is where the sheer audacity of their strategy becomes a massive liability.
Yeah.
They're trying to execute a dual mandate that requires two entirely different, highly specialized skill sets.
Yeah, completely different.
On one side of the house, they are doubling down as a hardcore space hardware manufacturing company.
Right.
They are building entirely new, next-generation satellite fleets called Pelican and Tanager.
Right.
But on the other side of the house, they are simultaneously trying to pivot into being a cutting-edge, artificial intelligence software company partnering with Google and Anthropic to build large language models.
Undertaking either of these initiatives alone would strain the resources of a mid-cap public company. Attempting both simultaneously creates an extraordinary execution risk.
It's insane.
Let us analyze the hardware side first. Across multiple earnings calls, including Q4 2023, management repeatedly references a significant step-up in CapEx capital expenditures.
They are very clear about where the money is going. The step-up in CapEx is being driven primarily by the Pelican program. They are spending millions to build technology demonstration units. They are bulk ordering highly specialized aerospace components for the first block of operational satellites, and they are spending heavily to upgrade their global network of ground stations to handle the increased data flow.
And then there is Tanager, which is an entirely separate program dedicated to high-resolution carbon and emissions mapping.
To justify this massive outlay of capital, management makes a very bold claim. On the earnings calls, they state that their internal target for the payback period on these new production satellites is less than 1 year.
On paper, a payback period of less than 1 year sounds like the greatest investment in the history of aerospace.
Seriously.
You spend $1 million manufacturing and launching a Pelican satellite, and within 12 months of it reaching orbit, the revenue it generates has entirely paid off its cost, and it is generating pure profit.
It is an incredibly attractive financial projection. However, as an investor hunting for a short, you must scrutinize the underlying assumptions required to achieve that 1-year payback. That metric assumes absolutely flawless execution.
Flawless.
But as the industry adage goes, space is hard.
Space is very hard, and Planet knows this. If we go back to the 2021 S4 risk factors, the lawyers spell out the brutal realities of the aerospace industry in terrifying detail.
Yeah, they list the myriad ways capital can be instantly vaporized.
They warn of delayed launches. They warn of catastrophic launch failures where the rocket simply explodes. They warn that even if the satellite survives the launch, it may fail to reach its planned orbital location.
Or they warn that the sensors may fail to deploy, rendering the satellite completely inoperable space junk.
Right. Hardware manufacturing and launch logistics are plagued by delays and cost overruns. If we assign a probability assessment to this over a 12 to 24-month horizon, the likelihood of value destruction, or at minimum sub-cost of capital returns, is exceptionally high.
Think about the mechanics of that 1-year payback claim. Every single time a Pelican launch is delayed because the launch provider has an issue, that 1-year payback period gets pushed further out into the future.
The capital has already been spent.
Exactly. It is sitting in a clean room on Earth, burning cash, generating zero revenue.
This is the definition of a CapEx trap. They must spend hundreds of millions of dollars upfront on research, component procurement, manufacturing labor, and launch contracts long before a single dollar of revenue is realized.
And if there are any operational hiccups,
Which history tells us are a near certainty in commercial aerospace.
right, the cash burn accelerates and the return on invested capital plummets.
And we must connect this back to our earlier findings. While they are pouring this massive step up in CapEx into the unproven Pelican and Tanager fleets, they are simultaneously admitting in the 10K that they might keep their legacy revenue-generating PlanetScope fleet at its current size.
They are bleeding cash on future hardware promises while intentionally starving the core moat that actually pays the bills.
It's a huge gamble, and we cannot ignore their historical track record regarding liquidity. The notes to the 2021 financial statements paint a grim picture of their past cash management.
Oh, this part is fascinating.
By October of 2021, prior to going public, they had amassed an accumulated deficit of $731.1 million.
The auditors actually slapped them with going concern warnings. They were burning cash so rapidly to build out the initial fleets that there was severe doubt about their ability to survive.
Yeah, they had debt facilities, specifically the SVB and Hercules loan, that included a terrifying springing maturity provision.
Meaning?
Essentially, if their cash dropped below a certain threshold, the lenders could immediately demand full repayment, which would have bankrupted the company.
While the public offerings significantly improved their balance sheet capitalization, that historical DNA of massive existential cash burn to achieve hardware goals remains a core part of the company's operational profile.
It's baked in.
And that is just the hardware risk. Now, we must evaluate the software pivot over a longer 5 to 10-year horizon.
This is the AI pivot. On the Q4 2026 earnings call, CEO Will Marshall explicitly planted the flag. He stated, Planet is the first space and AI company.
Right. They are pouring resources into artificial intelligence, specifically partnering with tech giants like Google and Anthropic to utilize large language models, or LLMs, to query their pixel data.
To understand the execution risk here, we have to understand the product they are trying to build. Historically, interpreting satellite imagery required a highly trained geospatial analyst. It was a bespoke manual process.
An analyst would spend hours poring over images to identify changes or count objects.
Exactly. But Planet wants to eliminate the analyst. They want a customer to be able to open a software interface, type a plain English question into a chatbot.
Something like, how many shipping containers are currently sitting in the Port of Long Beach today compared to exactly 1 year ago?
Right. And the AI model instantly interprets the raw pixels from the satellite feed and spits out the quantitative answer.
Robert Cardillo discussed this transition extensively. The goal is to move the industry away from an exquisite, slow, bespoke profession into a highly scalable software solution.
From a marketing perspective, it is a brilliant narrative. It generates immense hype in the financial press.
Of course it does.
But as public market investors tasked with stress testing this business, we have to separate the press release from the commercial reality. We have to assess the probability of this AI platform actually scaling into a profitable, mass-market commercial enterprise.
It is entirely plausible that legacy government intelligence agencies, like the NGA or NATO, possess the budgets to purchase these advanced AI analytic feeds.
Sure.
But Planet's valuation requires them to expand beyond the government sector. The critical question is whether they can convince a mid-size agricultural conglomerate in the Midwest or a regional supply chain manager to pay a massive premium subscription fee for an AI-queried satellite feed.
And building that AI infrastructure is astronomically expensive. They're trying to train proprietary multimodal models on massive spatial data sets. Running LLMs requires immense cloud computing power.
The structural headwind facing this initiative over the next decade is the probability that this software R&D consumes vast amounts of capital without ever producing commensurate commercial returns.
It brings us right back to the dual mandate problem. They're taking on the relentless hardware execution risk of a dedicated aerospace company like Maxar or SpaceX, while simultaneously taking on the software R&D cash burn of an AI company like OpenAI.
All while operating with the balance sheet of a mid-cap public company.
Exactly. History is littered with the corpses of companies that tried to pioneer simultaneous revolutions in hardware and software. They stretched their capital too thin, failed to achieve dominance in either category, and deliver sub-cost of capital returns to their shareholders.
The bear case narrative we have constructed is incredibly robust.
Let's review the prosecution's case. We have a foundational competitive moat, the daily scan, that is actively eroding because management is intentionally stalling the expansion of the legacy fleet while well-funded rivals aggressively scale up.
Check.
We have an executive team that is entirely entrenched behind a public benefit corporation dual-class structure, rendering them immune to activist shareholder intervention.
Check.
We have a demonstrated history of terrible capital allocation, highlighted by issuing equity to pay massive goodwill premiums for acquisitions like Boundless. We have identified aggressive accounting practices, specifically the use of upfront revenue recognition on archive data, which can pull forward demand and mask weakness in recurring subscriptions.
Double check.
And finally, they are walking blindly into a massive capex trap, burning hundreds of millions on unproven Pelican hardware while simultaneously lighting cash on fire trying to compete in the AI software space.
If you presented that thesis to a hedge fund portfolio manager, it would sound like a slam dunk high conviction short.
It sounds perfect. It sounds exactly like the clean, jagged white line on an X-ray we talked about at the beginning of the show.
It does.
But
This is the exact moment we must invoke the intellectual honesty clause. We promised you, the listener, that we would not manufacture a bearish conclusion if the fundamental evidence does not support it.
you have to follow the data.
And to be intellectually honest, we have to look past the governance red flags and the capex risks. And we must rigorously stress test the absolute core foundation of any fundamental short thesis, the unit economics.
If a company's underlying unit economics are healthy, scaling, and generating cash, attempting to short the stock based purely on fundamental decay is incredibly dangerous.
This is a widowmaker trade.
You can hate the management team's dual-class structure, and you can believe their capex plans are foolish, but if the core engine of the business is printing money, a short seller will eventually be crushed. We have to look at the actual financial performance metrics provided in the documents.
And when you pull up the actual numbers, the aggressive, pure fundamental short thesis hits a brick wall. Let's look closely at the gross margins, because this is where the bear case completely falls apart.
Gross margins are the ultimate indicator of pricing power and cost efficiency. In the 2021 Investor Day presentation, Planet provided a critical piece of data.
What was it?
They revealed that the PlanetScope fleet, which is the legacy constellation doing the daily scan, and accounted for roughly 73% of their total revenue in fiscal year 2021, was operating with gross margins of approximately 62%.
Let's just pause and appreciate that number.
Yeah.
62% gross margins for a company that manufactures, launches, and operates physical hardware in space.
It's a software-like margin.
It really is. And what makes it even more devastating for the short thesis is a clarification CEO Will Marshall made during the pre-IPO investor call in October of 2021.
Right.
Investors naturally assumed that because Planet builds physical satellites, their margins would eventually be crushed by depreciation costs. But Marshall explicitly stated that the 62% gross margin figure already includes the cost of satellite depreciation.
And those margins did not degrade over time. They expanded. If we move forward to the Q2 2023 earnings call, Ashley Johnson reported that the company's overall non-GAAP gross margin expanded to 52% for the quarter. That was a massive jump from 36% in the prior year.
We have to explain the mechanics of why that margin expansion is happening, because it is the secret weapon of their business model. It is the one-to-many data subscription model.
Let us contrast this with the legacy space industry we discussed earlier. When a traditional satellite provider takes that high-resolution staring image for a government client, they are executing a one-to-one business model.
Right. They built the satellite, tasked it, and took the photo exclusively for one paying customer.
But Planet's daily scan captures everything, regardless of whether a specific customer asked for it that day. The image of the Port of Long Beach is already sitting on their servers.
Therefore, the incremental cost required to serve a second, third, or thousandth customer with that exact same data is virtually zero.
Exactly. The cost of goods sold, or COGS, for Planet are essentially fixed. The Q4 2026 earnings presentation clearly outlines what constitutes their COGS: cloud hosting fees to store the data, the depreciation of the physical satellites, the salaries of the mission operations teams, and basic technical support.
Here is the magic of the one-to-many model. Once your initial base of subscribers covers those fixed COGS, every single additional subscription you sell drops straight to the bottom line.
Will Marshall laid this out plainly on the pre-IPO call, stating that every incremental customer is essentially pure profit that can be reinvested back into the business.
When revenue scales against a fixed cost base, gross margins mathematically have to explode upwards. And the documents prove definitively that this is happening.
The revenue is scaling aggressively. The Q4 2026 press release details record revenue, growing 41% year-over-year in the fourth quarter.
But the most terrifying metric for a short seller is the backlog. Planet reported a contracted backlog of $900 million. That represents 79% growth year-over-year.
Let's explain what backlog means in this context. Backlog is contracted revenue that customers have legally committed to pay, but Planet hasn't recognized yet because they haven't delivered the service over the life of the contract.
A $900 million backlog provides massive, multi-year revenue visibility.
It completely destroys the narrative that demand is softening or that competitors with new fleets are successfully stealing market share in the immediate term.
The customer growth metrics further validate this demand. The Q2 2024 presentation showed that customers generating over $100,000 in annual contract value grew from 90 to 137 over a 2-year period. Furthermore, their million-dollar-plus enterprise customers grew from 19 to 28.
They are successfully executing a land and expand strategy with massive government and enterprise clients.
Remember the NATO contract mentioned in the filings? They won that contract specifically because their temporal daily scan capability for maritime domain awareness and land surveillance was simply unmatched by the competition.
The National Geospatial Intelligence Agency and international defense ministries are locking into massive long-term contracts.
And this brings us to the final, fatal blow to the aggressive short thesis. The ultimate destination of scaling revenue and expanding gross margins is profitability.
On the Q2 2026 earnings call, management confirmed they successfully reached their adjusted EBITDA and free cash flow profitability milestones.
Free cash flow profitability. They are no longer burning cash from their daily operations. The core business is generating surplus cash.
If we adhere to our intellectual honesty clause, we must concede that the pure financial decay thesis is dead on arrival. If you are a public market investor attempting to construct a high-conviction short based on the premise of deteriorating unit economics, Planet Labs will destroy your portfolio.
You simply cannot successfully short a company fundamentally when their gross margins are climbing past 50%, their contracted backlog is approaching $1 billion, and they have crossed the threshold into free cash flow profitability.
The mechanics of the one-to-many model, selling the exact same digital image 1,000 times at zero marginal cost, are incredibly robust.
The management team might be deeply entrenched and insulated from accountability. The massive capital expenditures required for the Pelican and Tanager fleets might carry immense execution risk. But the underlying engine of the legacy PlanetScope business is undeniably healthy and generating cash.
So where does this leave you, the investor? We set out on a mission to find a high-conviction short, and we found a business with unit economics that are, frankly, unshortable.
We have to synthesize all of these contradictory layers, the governance risks versus the financial strengths, into a final, highly nuanced verdict.
The definitive conclusion of this deep dive is a defensible no thesis regarding a fundamental short. Because the core unit economics are scaling, margins are healthy, and the backlog provides massive revenue visibility, Executing a traditional fundamental short is a profoundly dangerous trade.
You do not step in front of a freight train that is fueled by a $900 million backlog and expanding margins.
However, we do not just walk away declaring it a flawless enterprise. A very specific, highly cautious structural short argument does exist, but it exists strictly on the periphery of the core business.
Precisely. If a portfolio manager was absolutely forced to short this stock, or if they were constructing a hedge against a broader aerospace portfolio, the thesis would be built entirely on governance vulnerabilities and future execution risk.
You would be shorting the Public Benefit Corporation dual-class shield that protects the founders from any meaningful oversight.
Right, and you would be closely monitoring the aggressive upfront revenue recognition applied to that 8% archive data segment, waiting to see if it's being used to mask a sudden deceleration in core subscriptions.
And most critically, you would be shorting the massive execution risk embedded in the upcoming CapEx cycle. Your bet would be that the aerospace industry remains brutally unforgiving.
You would bet that Pelican launches face catastrophic delays, that the new hardware fails to generate that promised one-year payback, and that the highly speculative AI software R&D burns through all the cash generated by the legacy business.
You are essentially betting that management's decision to intentionally stagnate the legacy PlanetScope fleet in order to fund these risky new ventures will eventually allow well-funded competitors to catch up and destroy the original temporal moat.
But we must be clear. That is a highly speculative short based on the anticipation of future execution failure. It is not a fundamental short based on current financial decay.
No, it's not. For the primary mission we established at the beginning of this deep dive, the verdict is to pass.
We looked at the murky diagnostic X-ray. The patient certainly makes questionable lifestyle choices regarding corporate governance and capital allocation, but the cardiovascular system, the unit economics, is pumping incredibly strong.
I love that visualization. The unit economics are the heartbeat, and right now, the pulse is undeniable.
But before we wrap up this deep dive and put the SEC filings away, I want to leave you with one final provocative thread to pull on. It is something we didn't fully explore in the main analysis, but it builds on everything we just discussed regarding their future plans.
Consider the ultimate implications of their AI pivot. Planet constantly reiterates their ambition to be the first true space and AI company.
Their stated goal is to use large language models to make querying their proprietary pixel data as easy and intuitive as asking a chatbot a question.
How many ships are currently docked in the port?
Exactly that kind of query. But let us extrapolate that technological curve. If the artificial intelligence revolution truly achieves this level of sophistication, if computer vision, spatial algorithms, and multimodal LLMs become ubiquitous, highly accurate, and incredibly cheap to run, does that actually make Planet's proprietary daily scan data more valuable?
Or does the AI revolution eventually commoditize all satellite imagery?
Think about the mechanics of this. If the AI models become smart enough to infer high-resolution details from low-resolution data, could a savvy commercial customer simply bypass Planet entirely?
Could they stitch together free, lower-resolution public data from NASA's Landsat program and the European Space Agency's Sentinel satellites?
Run that free data through a nearly free open-source AI model and generate the exact same logistical insights without ever paying Planet Labs a dime for their proprietary feed.
It presents the ultimate corporate irony. In their aggressive rush to build the artificial intelligence tools necessary to unlock the commercial value of their dataset, Planet Labs might inadvertently be funding and developing the very technologies that ultimately render their proprietary data obsolete.
It brings us right back to where we started. We were looking for a clean, binary X-ray of this company's health. Broken or not broken, buy or short.
But the public markets resist simplicity. And at the bleeding edge where aerospace engineering collides with artificial intelligence, the diagnostic landscape is never that clean.
The jagged white lines of vulnerability are definitely there, hidden in the proxy statements, the capital expenditure projections, and the technological shifts. But right now, the sheer brute force of their one-to-many unit economics is keeping the patient not just alive, but thriving in the muddy waters. Thank you for joining us on this deep dive into the filings. Keep questioning the consensus, keep reading the footnotes, and we'll see you next time.